Welcome to this explainer. Right now, we're unpacking a massive, literally existential crossroads that Qualcomm is facing today in August 2026. For decades, this brand has basically been the absolute bedrock of smartphones. But today, they are attempting a monumental $170 billion pivot. They're trying to transition away from that fading smartphone legacy and push all their chips into the high-stakes frontiers of artificial intelligence and automotive tech.
Let's dive right into the market's anxiety. Qualcomm stock has plummeted 35% from its highs just back in May of 2026. Investors are basically watching a company that defined an entire era try to redefine itself overnight. And frankly, that massive transition is making Wall Street very, very nervous.
So, that brings us to the ultimate question we're going to answer today by breaking down the hard data. Are we looking at a falling giant trapped in a shrinking industry? Or, actually, is this a deeply misunderstood, once-in-a-decade turnaround opportunity?
Here's our roadmap to figure this out. The smartphone problem, the automotive engine, the data center gamble, the Wall Street divide, and finally, risks and valuation. Let's get right into it.
Starting with Section 1, the smartphone problem. Basically, a shrinking core.
Qualcomm's third quarter fiscal 2026 results show a company under severe pressure. And what's really interesting here is the sheer scale of the drop. QCT handset revenue absolutely plunged 20% year over year, landing at $5.1 billion. Smartphone manufacturers are actively cutting chip purchases and working down their inventory. It's a massive hit to the very foundation of Qualcomm's historical success.
But wait, there is an even bigger threat looming, and it's on a very rapid timeline. The Apple exit. Today, Qualcomm supplies modems for about 20% of iPhones. By late 2026, management is fully expecting a 50% sequential drop in that revenue. And by 2027, zero. Done. Apple is taking it all in-house and completely severing ties with Qualcomm modems.
So their biggest revenue stream is being violently attacked from literally both sides. You have contracting consumer demand and the total loss of a key customer. Plus, on top of all that, soaring memory prices and supply constraints are making phones way more expensive to build, which is just squeezing margins for everyone involved.
Which brings us to Section 2, the automotive engine, or as I like to call it, silicon on wheels.
With smartphones struggling so much, they desperately need a new growth engine. And right now, their automotive revenue is absolutely on fire. Q3 just hit a record $1.6 billion. That is a staggering growth rate of 61% year over year, and it actually marks their 23rd consecutive quarter of double-digit growth.
And this momentum is being driven by some really massive strategic wins. They've just been chosen as BMW's lead compute provider for next-gen ADAS, and they secured a collaboration with Stellantis that extends way into the 2030s. With their Snapdragon digital chassis ramping up right now in September 2026, they are targeting a $7 billion annualized run rate exiting this fiscal year. But, and this is a big but, we've got to keep perspective here. A $7 billion run rate is still only about 1/6 of their total business. It's growing fast, for sure, but it cannot save them alone.
So, if cars can't do it alone, what's the backup plan? Section 3, the data center gamble. Fighting Goliath.
This brings us to the company's biggest, boldest, and arguably riskiest bet yet. Look, taking on NVIDIA right now is kind of like stepping in front of a freight train, but Qualcomm is doing exactly that. At their June 2026 Investor Day, they unveiled the Dragonfly C1000. It's this massive 250-core server CPU built on their custom Orion architecture. And guys, it's not vaporware. They've already secured tech giants like Meta for 2028 production, along with Microsoft's Azure Cloud Unit.
But management knows you don't win AI wars with just hardware, right? So they swooped in and acquired an AI software startup called Modular for $4 billion in stock. Modular software is super clever. It actually lets AI models run across different chips without needing processor-specific code. This is a direct, highly calculated attack on NVIDIA's CUDA platform. They want to completely break the deep vendor lock-in that defines the AI industry today.
CEO Cristiano Amon's strategy is crystal clear. As he puts it, we believe the future belongs to developer-friendly, horizontal platforms that can run across diverse compute environments and give customers real choice. He is intentionally setting up this epic Goliath versus Goliath narrative, betting heavily that the market is just desperate for a viable, open alternative to NVIDIA's closed ecosystem. But here is the catch. And there's always a catch, isn't there? While their ultimate goal is to reach $15 billion in data center revenue by 2029, just getting there is going to be really painful for margins. Heavy initial R&D and deploying these lower-margin custom chips will actually drag their weighted average gross margin down by about 1.5 to 2% in the near term. This massive transition, it's going to be incredibly expensive before it becomes truly profitable.
Which naturally leads us right into Section 4, the Wall Street divide. Show me the revenue.
When you have a pivot this huge, with the real payoffs pushed out years into the future, it creates deep, deep uncertainty. The analyst ratings right now perfectly capture this. Out of 37 analysts, the consensus is squarely a hold, with 20 sitting firmly on the fence in the middle. The average price target is around $193, but individual targets are wildly fractured. I mean, we're talking ranging from $100 down at the bottom all the way up to $400 at the top. Wall Street literally cannot agree on what this company is worth today.
The skeptics, like this analyst from Bernstein, sum up the bearish perspective pretty perfectly. They argue that it's hard to justify paying a premium right now when a good amount of that 2029 data center success might already be priced into the stock. Basically, they're terrified investors are paying today for an AI victory that won't even materialize for years, if it happens at all.
All right, let's wrap this all up in Section 5, Risks and Valuation, the verdict.
Let's objectively look at the reality here. The headwinds are pretty fierce. They are facing the unpriced impacts of Apple walking away. EBT margins have contracted to 26%, and R&D costs, they just surged to $2.61 billion in Q3 alone. They are stepping into a brutal competitive arena against entrenched giants, all while trying to navigate a highly complex operating environment in China with escalating tariffs. It's a lot to handle.
And yet, despite all of that doom and gloom, from a valuation standpoint, trading at roughly a 16 times forward PE with a 2.3% dividend yield, this $170 billion tech giant actually looks surprisingly cheap, especially when you consider that you have a stable, cash-generating licensing business backing the whole operation up.
It essentially boils down to this massive tug of war. The bulls out there see a stable cash cow that is basically funding a free option on huge automotive and AI upside. The bears, on the other hand, just see a shrinking core handset business desperately making a highly risky gamble in an arena where they are arriving incredibly late.
So what does management have to say about all this skepticism? Well, their answer is actually quite straightforward. They plan to accelerate non-handset growth to over 60% in fiscal 2027. They're betting the farm that this rapid acceleration in automotive and AI is going to be enough to completely replace the massive revenue hole that Apple is leaving behind.
So I'm going to leave you with this final provocative thought for your own research. Does this $170 billion giant really have the agility and the technological firepower to conquer the AI data center and pull off this turnaround? Or is the road ahead simply too steep, and that distant promise of 2029 is already completely baked into the price? Thanks for joining us for this explainer. We'll see you next time.